All right. We do have a small group joining us here. So Brian and Karen, you guys are going to have a lot of opportunity for some questions, but as we always do, we'll send out the recording to all of our board members as well as our finance and committee members. So um, we will go ahead and get started, and we'll start with a quick prayer, a prayer of charity. In the name of the Father and the Son and the Holy Spirit. Amen. Gracious God, I offer you my heartfelt gratitude for your countless graces and blessings to me and my loved ones each day. In response to your goodness, dear Lord, help me to be aware of the needs of my least sisters and brothers and to assist those who are poor and less fortunate with generous expressions of charity, kindness, and caring. On that day, O Lord, when I finally stand before you to give an account of my life, I pray I will hear you say, "Come, O good and faithful servant, to share your Father's joy. For when I was hungry, thirsty, naked, homeless, ill, and imprisoned, you offered your gifts in charity, and you lovingly did it for me." Amen. In the Father, Son, Holy Spirit. Amen.
Amen.
All right. With that, I will pass it over to Ryder and Troy to lead us through our market update and through the various portfolios of the foundation. So take it away, guys.
Welcome. Thanks for joining, and it's been an interesting time. We're going to review our thoughts on the current state of the economy, our outlook. We have an update on asset allocation and performance. Certainly open it up to questions. Earlier this week, we did have our chief investment strategist, Jeff Mortimer, present as well. And I'll be curious to see if Kyle has any thoughts on that as we present as well. But yeah, it is interesting times, and we are closely monitoring all of those things that you would expect us to appropriately set asset allocation for the sake of weathering what may be a challenging year. So I'll hand it off to Troy, and we can get started.
Okay, thank you very much, Ryder, and hello, everyone. Thank you again for having us, and of course, your trust in our stewardship of these assets. We are going to go through, as Ryder indicated, our economic and capital markets overview, and I wanted to start with a bit of a look back at what's happened recently, and then also a further look back on what's happened really in the past 5-10 years, even though year over year, markets have done very well. We're entering a period, and we kind of expected to see some more volatility this year, and we've seen it. And some of it came in the first quarter. There was a bit of a respite toward the end of the quarter. And now in April, once again, we're facing some of that volatility. So you can see by this chart, U.S. equities have outperformed on a relative basis versus mid, small cap, emerging markets, and even bonds in this environment of rising rates. There's really been not too many places to hide. So from that standpoint, obviously, it's always difficult to go through periods like this. We maintain that, and history has shown that if you can weather this storm rather than trying to time markets, it's important. We have some slides later in the deck that point that out. But when we look, these numbers aren't completely updated through today. When I looked at numbers, the S&P 500 was down in the neighborhood of 12% through today, so year to date. So obviously, some more chop in the market, some concerns still about inflation, Russia, Ukraine, as well as really what the Fed is going to do to tamp down some of the inflation that we're seeing. And certainly some concerns about the economy, and really the market itself is a bit of it is a leading indicator to the economy and not the other way around. So from this chart, we also again see that it is large cap, and we've been overweight to that asset class. So on a relative basis, that's been helpful to the portfolio overall. And we have made some changes that I'll go through later to dampen some of this effect as well on the margin. And we do have some diversification in the portfolio that has done well in terms of commodities. So that's buffered a bit, even though we have a fairly small piece in that space. When we look back and think about how far we've come, though, and you look at large cap stocks up nearly 16% year over year through March 31st, and on down the line in terms of longer term returns, we've had a very, very strong market. So it's somewhat expected that we might have a pause at some point, or at least some greater choppiness. And we're a bit at a fork in the road, as Ryder alluded to, that we're monitoring a number of different factors. But we always have to keep in mind during these times that it's best to really stick to the plan, as it were, and know that the economy has been, and the markets have been, very resilient through all of this. And we think that although we have lower expectations in terms of the economy, and those may adjust further, and that translates also into our expectations for the market. Let's look ahead to some of the changes that we've made to our outlook based upon the things that we're seeing on the ground. And U.S. GDP, I know there was a print today that came in negative for the quarter. That could get revision. So we do think that the economy as a whole, though, continues to grow. The consumer has been fairly resilient in the face of inflation. And company earnings, while they've been somewhat mixed, they still have come in on a nominal basis better. So we do see continued inflation, but by the same token, as you can see by our chart, and we're showing higher, this is for 2022, we think that it will come to pass after some time that that does get reined in, and the market expectation is that as well, and we'll go through some charts to kind of point that out. And then you see our earnings really haven't changed, and I guess, and that's also thinking from a nominal basis, as inflation actually has helped to fuel some of those at least earnings in the short run. We may see inflation effect start to dampen that as we move forward. So our year-end target for the S&P 500 has also come down. And if you take that from the beginning of the year where we started, it bodes for a flat to down year potentially overall. But from the point we're at now, we could see some recovery depending on a number of factors that we're watching. From a yield standpoint and interest rate standpoint, yields have already gone beyond our expectations, and we think that that may be a bit ahead of itself in terms of where that's moved. We don't expect a really crazy spiraling of rates, and certainly the short end is going to be moving up to catch up with the longer end a bit. We've already seen a bit of a 2 to 10 inversion where that does potentially sometimes signal recession, but typically that doesn't come until into further phases of the cycle. So we may not see that until next year. We have raised our expectations of the potential for a recession, and we can get into that more a bit later as well. Inflation has definitely weighed on growth, though, overall, and it's been persistent. And there are a number of factors contributing to that, and we can go through the list. I'm sure that everyone is aware of Ukraine, fiscal spending, different things that tend to create that. And then we've also seen a very tight labor market. So we also have a chart, and that tends to make inflation a bit more sticky and kind of feeds upon itself as higher wages translate into people being able to afford some of the inflation that's coming. On this slide, we have CPI, and the Fed uses generally CPE, and there's headline CPI, core CPI, and core PCE, and the headline includes food and oil and energy, but the core does not. And across the board, though, things are inflated, and the expectation, though, when we look at the consumer sees inflation increasing in the shorter run, but in the longer term, as we view it as well, that will eventually be tamped down by either Fed action or natural forces. Potentially open up further supply if there's a resolution in Ukraine. That could lead to helpful direction. As I mentioned, wage growth, you can see from this chart, median wages going up and very low unemployment, and also in the labor market, you see more people have entered the workforce to really high levels, and so there's not much slack in terms of that, and that again is indicative of a sticky inflationary effect that's going to be with us longer. So I mentioned the Fed and what they're doing, and it's been cited potentially that they could be a bit behind on raising rates to account for some of the inflation that we're seeing to slow things down. They're still trying to do that and engineer a soft landing, and so we've Jeff Mortimer, I know, talked about this, and we'll talk about it further when we get to his chart that kind of depicts the cycles of the economy and markets. But this chart specifically shows Fed estimates versus market estimates, and you can see the market estimates depicted by Fed futures in orange tend to align with the Fed estimate as we go down the line, as we get into the future. So right now, the market is pricing some of that in. So there is the potential that if the Fed does go a little bit slower, which I think, our thinking is it might be front-loaded before the election. But if there is any less or a lower raise than is expected, that could fuel markets. At the same time, it's kind of a double-edged sword, because then are you really contending with the inflationary effect? So we'll have some numbers on percentage-wise about in the effects of inflation, as well as the potential for recession when we talk about.
I'll just chime in real quick on this idea here. Markets have been primarily reacting to Fed policy adjustments in the last several weeks here. And the Fed has, in their commentary, become a little bit more hawkish, but the market's job is to pretty much discount like the worst case scenario. And so there is a chance that as the Fed implements this monetary policy adjustment, that it is somewhat effective. And even here on this chart, you can see in the outer year 2024, the market expectation is that the Fed funds rate may actually come down a bit, which is probably an indication that if we go a little bit too much or put the brakes on the economy too much, that they've got that tool in their toolbox to reduce rates. And so that's a normal part of the cycle. As it stands today, though, the market, with the current expectations so high of higher rates, the market is discounting really all that, kind of those worst possible scenarios.
Right. Well said, Ryder, and it does provide that potential for dry powder, so to speak, in terms of rates if they do need it. Here we just see the yield curve, and we've talked a lot about this. And once again, we'll tend to see the front end of the curve start to go up as the Fed makes its moves. Once we do get into a position potentially where very short rates get higher, or even with longer rates, that's even more of an indicator for potential recession on the horizon. Now, we haven't seen that yet, even though, as I mentioned, we've had the 2 to 10 inversion for a short period. It's something to consider and look at. It's not always correct, but it's one of those things that we're monitoring closely for positioning in the portfolio. Just looking back into history at other time periods where we've had tightening cycles, and these periods aren't necessarily just a one-year period. They span different time periods during areas where we've tightened, or the Fed has tightened to slow the economy. And I think one of the takeaways from this is that there still is some potential for markets to continue upward, although typically you do see some additional volatility, and the average rates or the average returns overall are lower. But there have been times when we've raised rates. I can think back to, this depicts the 04 to 06 period, or the 94 to 95 period, where although those times had positive results or slightly positive, the years after that, and sometimes recession followed that, but we're still in the fairly early innings of that cycle. And so there's some solace to be had in that we could still navigate through this. This slide depicts investor sentiment, and during periods of lower sentiment, and really during periods of kind of below the target, if you will, the 57 to 66 are when markets perform the best. But we're in a period where sentiment is below 57, but you still see that during periods of pessimism, you do tend to get the markets do tend to move in the other direction. Now, I will admit some of this is chicken and the egg. So sometimes the sentiment is a result of markets going down, and of course, buying in the markets when they're down, typically over the longer term time period, has been a good thing. But it's just some food for thought. And another kind of reminder not to overreact when markets do take a downturn. Incrementally, yes, adjusting portfolios is very smart, but on the next slide, we can see the dangers of trying to time the market and having to be right twice, when to get in, when to get out. Since this portfolio is really designed for long-term returns, trying to do that adds an element of risk in and of itself to the portfolio. So remaining fully invested, making adjustments, making tactical adjustments in the meantime is the best course during these times. And trying to time the market, you can be out for even a very short period of time and miss out if the market does and will eventually rebound. And here's the chart I mentioned, and I'm going to hand it over to Ryder to kind of talk through this a bit. Jeff Morgan, I know, as he mentioned, Chief Investment Strategist, went through this, and he's the originator of this chart. And it really kind of helps us to form some of our opinions and look at different cycles. So from there, I will hand it over to Ryan.
Thanks, Troy. And again, I know some of you just saw this on Tuesday at our luncheon, but it bears repeating. Where we are in the what is ultimately somewhat normal cycle that we've seen over and over and over again in history is, coming off of the lows of the pandemic, full recovery with a lot of money pumped into the economy. And we're dealing with these elements on the upper left-hand side of the chart there that talk about rising inflation and rising interest rates. And more often than not, and you could probably say every time, the economic peaks are, essentially murdered by Fed action. That's a typical mantra, is that the Fed has a lot of power, and when they observe, especially today, which we haven't seen in many years, a real spike in inflation, their job, their mandate is to head that off at the pass, essentially. And the risk that markets perceive is, okay, we get it, they have to do their job, but there's always the risk that they do too much, too far, too fast, and it throws the economy into a much tougher slog. And that could look like a real contraction in the economy, to where people start to get laid off and businesses have to restructure, just like we saw in the last recession, which was pandemic induced. It would be all those same things. And so that's the risk that the market is currently tackling and having to deal with and trying to price. Our belief is that the starting point of where we are today in the beginning of this tightening cycle from the Fed is in a really healthy position. The economy has been performing well. There's a lot of health, there's a lot of liquidity still out there, even on the sidelines, to the point that if the Fed gets their interest rate policy to neutral, you'll notice on this chart where it says rising interest rates, it actually says tight. The prospect of going towards, say, 2.5 or 3% on the Fed funds is actually not tight. It's in their view neutral. Our view is that the economy and the market can weather that storm and potentially be in a better position across the board, especially with savers and all that, to regroup and get back on track of some continued expansion. The risk, though, is that the Fed makes a policy mistake, because we don't know exactly how they fine tune that. And if they do make a mistake, maybe go too far, maybe not enough, who knows, that it could throw us over into some tough times. And so we're truly at that fork in the road. This clock, this cycle, this wheel, 9 o'clocks go to one of two spots. They go to 10. That says, oh, okay, we weathered the storm and got to the other side of the hump and going to continue working. Or sometimes it'll go directly from 9 to 12, which is falling into a bit of a quagmire and having to deal with a little bit more damage. And I know Jeff put the odds at like a 60-40 between going into a 12 or a 10. I've been using kind of a 50-50. It's a bit of a crapshoot. And when you're faced with that, you do what we are currently doing, is on the margin, reducing areas in the portfolio that could be hurt more, namely small cap and now high yield, to defend a bit on the margin. We were very reluctant to time the market. It makes no sense to make wholesale shifts, but to make slight percentage moves here and there, it makes a lot of sense. And as it stands, we are neutral. On the next page, Troy, you can see.
Ryder,
Yep.
It's Karen. I have a question. So, have we ever seen in history the kind of money that's been printed, right, even, what's her name, in charge of the International Monetary Fund, came out and said, oh, whoops, we printed too much money. So, I mean, they have just flooded with money, right?
Yeah.
So we've never really had that much money flooded in by the feds. And so I still am thinking that inflation is going to be here to haunt us for some time to come.
So there's two sides that there's been, direct funds being pumped into people's hands. And there's also been Treasury balance sheet or Fed balance sheet actions in the form of quantitative easing. And, it could be about a 50-50 split. And part of the Fed policy shift is to start letting bonds mature and potentially even sell bonds. And that's, what is that, $8 or $9 trillion just in that. And so some of that is going to come off. At the same time, you still have folks with actual cash on their balance sheet that for the regular consumer, there's some, but not a whole hell of a lot. And the idea of the current inflation that we've been dealing with say high gasoline prices and housing, typically the natural forces, I think you might have heard Jeff Mortimer mention, that the cure for high oil prices is high oil prices. We do not believe that the current trajectory, the rate of change of inflation is going to remain at this elevated level. Still will be positive, though. We think that inflation is probably going to stick with us for a while. But we don't believe that it's going to get into a kind of a wage spiral. We've seen wages increase, but what's different today than it was before we had kind of the last time of big inflation, we don't have a lot of that collective bargaining happening where you've got guaranteed 10% COLAs embedded in contracts. There's a lot more flexibility. The employee has a lot of power today, but the employer will ultimately have some power too. So we don't believe that inflation at this level will haunt us for a real extended period of time. We think it'll actually, within the next 6 to 12 months, start to level down into the 3 to 4% range. That's what we're using.
Well, time will tell.
Time will tell.
I will add, time will tell. And, I'll just add to that just briefly a little bit. When you talk about money printing or, in terms of Fed action or inflation through, fiscal stimulus, one thing that we've had economists in the past talk about is it goes into our longer term capital market assumptions as well. So when you look over the next 10 years, it does tend to dampen the potential growth in our economy. So from that standpoint, it also affects markets. And therefore, when you look out over the next 10 years, it does create an environment for tougher sledding, slower growth. They talk about growth that is normal, but we may end up having growth that is below normal for a more extended period, and hence lower expectations for markets in general.
Yeah, look, we're not ignorant to history. When you have really high inflation, really high rates, the price that you're willing to pay for lower growth is a lot less. And so with PE levels recently having been in the 20s and obviously are coming down appropriately now, we've seen times when PEs are in the 10s and 12s, and that's where you really take the damage. So we're very aware of what history has shown us, but we're also pretty aware of how things are actually different today, especially in the way that the Fed operates. the Fed is essentially projecting what they're going to do, and they're following through and doing it, and a fair amount of transparency, and markets still have been resilient. The downturn that we've seen so far, quite honestly, is just a bit of a give back of last year's returns. It's not really yet been a true what do you want to say, bear market per se. You know, the S&P is down. Actually, today we have some positive things. So we're down slightly less than 10% on the S&P, a little bit more on the NASDAQ. But if you go back one page, Troy, the ways that we handle these uncertainties, I guess you could say, within portfolios that are really long term. You know, even if we have a much more significant drawdown, we're gonna stick with the broad stroke, but within each of these asset classes, you can bias your portfolio a certain way. So one example would be with certain underlying managers. If it's a tougher slog economically, you want to own those companies that have the biggest and healthiest balance sheets, generally US large cap. Those are the companies that have a lot more flexibility to do what they need to do to stay in business, as opposed to the smaller companies that are maybe using more debt. You also, as we're also doing now, is reducing some high yield. If the odds of default rates are going higher, then you want to take advantage of the tight spreads that we have today to shore up and really just position the portfolio to go high quality. And that's the stance that you take. But the question is, if we end up with a real soft landing and we weather the storm, you know, this year maybe isn't so great, but we get through it, then the growth side of the portfolio is much more appreciated, and you would actually be better off or orienting towards you know, the other side of that coin, like we saw in the late 90s. After the tightening of 94, you had 95, 6, 7, 8, and 9, which were all double-digit years. So that's what we're trying to figure out right now, and we're taking a very cautious approach. We are neutral on our stock positions and tweaking those areas on the margin to be prepared for whatever may come.
Okay, I think that's wise.
Yep.
Thank you. So let's jump into the portfolio as it stands as of 3/31. Unless there are any other questions, I should pause for a second.
Troy, this is Kyle. Just a quick question. Earlier in the presentation, you had mentioned, you know, the possibility for recovery later in this year, and there's a few things that you guys are keeping your eye on. In particular, what are some of those areas that you think are going to influence, you know, particularly the next, you know, 12 to 18 months that you guys are most concerned about, or really mostly keeping an eye on? What are some of those areas?
Sure, and you know, I think we touched upon a number of them, and really close eye on the Fed and inflation. Things like Russia, Ukraine, the resolution there that could have, you know, play a role. Supply chain issues, how the consumer is weathering the inflation, and really just corporate earnings as well. And if those begin to falter, that you know, could be a negative sign. If we continue to see strong corporate earnings, and we see Ryder alluded to as a softer landing in terms of inflation coming down, the Fed raising rates, but not really getting to the point where we have a full-blown recession, or at least maybe a milder recession. And again, you see that light at the end of the tunnel where you start to see growth pick up, maybe the rest of the world. COVID doesn't really rear its ugly head again, so monitoring that. And then that means world economies begin to open up. So that's kind of the things that we look for on the plus side of the equation that could, shift things positive for markets.
Yeah, it's going to be a couple of quarters of earnings that'll really be proof in the pudding. Today the market is strong. We've had like recovery off of the last couple of days of lows, and it's because the worst fears of certain company reports weren't realized. And so the daily volatility is going to be very high. By the end of the year, time is your friend. Time helps you discover what's going to be the resolution in Ukraine. Time is going to be the cure to understand how supply chains may adjust here in the near future. Time is going to be your friend in getting past the November midterm elections. Typically when you have midterm election year, November and December are great months because there's no longer that unknown of who's going to control the Congress. So time is ultimately your friend. This next 6 months is just going to be a period of discovery, price discovery in markets, depending on how the data plays out.
Thank you.
Okay, anyone else? Okay, this gives you a snapshot of the various pools in the portfolio, and I would point out that we have added the capital preservation portfolio, and you see that in the next to the last slot at nearly 1.6 million. And the other various pools are listed here as well, for a total of, as of 3/31, 106 million. Here's our executive summary as we move into our allocation and performance measurement of the various portfolios. So this just gives you a snapshot and a takeaway of how the portfolios are targeted and where our neutrals are, and also their performance over the full year. So when we parse it down to very short time periods, even a year, you can have some fluctuation from quarter to quarter. So the further we go out, the more we'll be able to get additional perspective on how we're doing against those various benchmarks. But as you can see, for the 1 year period, we're still running ahead of the benchmark. The quarter was a bit tougher. And so there was some pullback overall from a year-over-year standpoint as well. But really across the board, when you look at the intermediate pool, 2.5% year-over-year versus 1.5% for the benchmark, and that targets a 50-50 allocation. And then the capital preservation pool, it being very new, and we're still implementing the investments in that. We're pretty much done. We're still going to do some tweaking. So we're going to have some more relevant numbers to start reporting through April.
Kyle,
on the Catholic savings.
Just real quick, Kyle, did you want me to, at this point, articulate some more granular details on how the structured notes work, or should I save that for Tuesday?
That'd be a good Tuesday. You can maybe talk a little more about that.
Okay.
Again, not a huge allocation or portfolio, but just again, maybe a good reiteration of that would be helpful.
Okay.
Yeah, and those structures are utilized both in the capital preservation pool as well as the Catholic savings pool as really a way to buffer some of the volatility that we're seeing, and potentially from a longer term standpoint add to the growth. Obviously, as we mentioned earlier, a very tough period for equities and bonds in the short run, and we've seen a rising rate environment that has reduced some of those bonds. Now, we are very short in duration in that portfolio. We're doing a bit better than the benchmark, and I'm referring to the Catholic savings pool. So that's another area as we start to reinvest in bonds that are going to be at higher yields, we will eventually start to see a recovery in that space. And, if we get to a point where things do overheat a bit on that end, we could even see some rates move back down on the short side, and we get the opposite effect and being helpful. So that's another area where we just have to continue to be patient, we think, and keep trying to find ways to augment and improve that. Here's an attribution piece as well. I can go through that as we talk about the portfolio, but I'll just mention a few points here. I did refer to the outperformance, and it's attributed overall to our bent towards large cap. Relative emerging markets performance from DFA has been helpful to the portfolio. Bond performance from a shorter duration standpoint, as well as high yield bonds, floating rate, and also commodities, as we saw in the beginning chart, have contributed on the positive side. Performance for the quarter, again, was a bit behind the benchmark, and that was mainly attributable to large cap and international manager relative performance. And when we see those pockets, and a lot of that can be explained in the large cap and international space by some of our Catholic restrictions. So defense stocks are one thing that we don't own that have done well through this period. So not owning them has hurt us on a relative basis. That tends to come out in the wash over a longer term time period in our experience. And when we look back at longer term numbers in those portfolios, they do still remain strong. And so again, I think once those things work themselves out, there will be times when we again outperform. Just favoring US though overall, and the manager performance in the small and mid cap space, that's mid cap. Emerging markets, as I mentioned, still was helpful, and overall our fixed income, and I'm speaking on a relative basis, so helping us to be a bit less negative than the market. So I covered all those points essentially, and so we can move now into endowment pools as well as those full assets, and the most aggressive of all the strategies of focus on long-term growth. And here we see the numbers that I mentioned for the year period and the 1 year period, still fairly early stages in our management history. So again, not to place too much emphasis on really short-term numbers. We're focused at the end of the day on very long-term returns. So you can see also the equity allocation pie. Now, that is done on a settlement date basis. So we did do some selling of additional small and mid-cap stocks at the end of the quarter that aren't necessarily reflected in this. So we're much closer to neutral. We're actually a bit under that 70% range right now in terms of equity allocation. So again, trying to reach that neutral for now, and we did some of that, selling into a stronger end of quarter than we had previously. So we were able to utilize some of the gains. You see your spender targets as well as your investment policy targets. And again, I spoke about how we're moving to neutral there, being a bit more defensive than we have been, because we have been intentionally overweight to those areas. And we're still underweight to areas like international developed due to growth concerns and really just we're not there yet. We think there could be potential because those areas are somewhat undervalued in terms of on a relative basis with U.S. stocks, but growth prospects and other factors not leading us to, invest heavily there at this point. Any questions on this slide? There's a lot.
Troy, just a quick comment. I'm looking at our target, and this is obviously something that'll come up in the first quarter of next year, our CPI plus 5.8%. Obviously, that's going to be a very hard threshold to hit going forward. Looking ahead, I guess our expectation for what we're looking to achieve, doesn't really look feasible. So I think that's a conversation that we'll be looking to expand on in terms of our target and that feasibility of that target. So I think that'll be an interesting thing for us to look at as a finance and investment committee going forward. So just a comment in general.
So Kyle, to kind of add on to what you just said. So what do you have in the budget? Did you have like what your expectations are, or which is really good? I agree with you. It's really going to be hard to hit. So
yeah, when we look at this from our budgeting standpoint, we're really budgeting more from a inflow outflow perspective. So we know what our spend is going to be, and we budget towards what our outflow is going to be, because generally not everyone takes the full spend. So while we may have a generally 4% spending rate, normally what is actually taken out may fall around 2.8, 2.9% of the overall portfolio. So that is unpredictable in terms of what the actual outflow is, but using history, that's what we're expecting. In terms of us, we're using the long-term market expectations. So, using that 5.5% is what we're expecting, creating that shortfall to some extent of that CPI component, right? We're not necessarily keeping up with inflation from what we're targeting. But again, we do that over a investment cycle is how we try to look at that, as opposed to year to year. So we'll see what that does over time too. So.
okay.
Yeah, no, it's a very valid point. It's going to be a more challenging number to reach. The only thing that I'll say, though, in addition to that, equity markets do sometimes do well if inflation doesn't overheat. So you can do well in an equity environment with inflation. That's part of the reason even you have equity as part of the portfolio. And really that CPI plus 5.8, I know it's a short-term time period here, but we're thinking about a long-term time period into the future. So, I agree that it's going to be a challenge, and we may have to, alter some thinking there, but at the same time, I think that over a long time period, it's still something that, we hope to shoot for.
Just a quick conceptual question, Troy. When we look at CPI, is that based off a 12-month rolling or a 12-month measure of CPI? So if we compare it, so if we're looking at, say, March 2022, we're actually comparing that to March 2021. Is that how that works from a CPI perspective of how you get that increase?
Yes, I believe that's correct.
Okay.
I could,
so again, that's where in the future, that way may look a lot better, because again, our prices are generally already going to be high, and inflation can't keep going up the way it is at this point in the future. So I think that's something where our CPI eventually will come down, where it does become more feasible, right? So it's not like we're going to see a lot of shrinking prices going forward. I can't see that happening once prices increase, but who knows?
Right. Yeah, you're right. That once it attains somewhat of a plateau, and that's one of the factors that helps to mitigate that type of persistent high inflation in general. So, okay. Another look at overall performance across the board, and we have our totals net of fees. Basically in line, though, at the top of the house, and then where we see equities a bit behind, and that's again due to, I think, the two areas, large cap and some of the underperformance on the international side as well. But again, longer term numbers, at least on this page, still hanging in there, and certainly commodities contributing on a positive basis, although it's a small piece. We're still looking, from a Catholic compliance perspective to add to alternatives. And I know we're furthering our discussion in regard to PE. So, those are other areas where we could potentially add longer term growth, as well as some buffers to what's going on, and take advantage of areas that actually do better in rising rate or high inflation environments. On the fixed income side, on a relative basis, you can see the numbers, although negative, are less negative than the overall market. So that's a positive, attributed to our management and the areas that we've gone into, specifically high yield floating rate. You can see on this page at the bottom, floating rate has helped emerging markets. Debt has not helped quite yet. It may be a period where that market is going through some flux, but at those times, often it is best to be patient and let that self work it through. Those markets tend to be a bit more volatile, so we potentially could see more upside as we move forward again. And part of that is all around that diversification. Just jumping back up to the equities, I think I kind of described what was going on there. And on the SMID cap side as well, in terms of the performance, international developed, both DFA and our separately managed international portfolio suffered a bit during this period, again, related to defense. Also, the separately managed portfolio is underweight in terms of financials. So that has not been helpful either. On the emerging market side, again, on a relative basis, doing very well, especially when we look out to inception with DFA. Part of emerging markets are tied to commodities markets. And so that's one area where inflation actually, can be of help, where you have stocks that benefit from some forms of inflation. And here's the breakdown of the individual assets in the portfolio. And I talked about all these individual assets in terms of their performance.
Troy, did we lose you there?
Okay, I apologize. I just got back on. Looks like Troy is also now getting disconnected for some reason. Sorry about that.
Yeah, it looks like we're probably stuck on Troy's portion of the slide deck too. So.
Oh, okay. Well, suffice it to say that, okay, we're looking at the asset allocation changes. And to some extent, like I mentioned before, we are drifting towards a neutral positioning. Some of that the market has taken care of for us, but we also did some rebalancing at the beginning of the year, which was all relatively additive. And that would carry through to all segments of the portfolio. The performance, as you might know, this year the markets are down, and those areas that are down the most, primarily growth, had been contributors to a lot of our outperformance, a lot of our managers' outperformance of the last couple of years. And so generally speaking, this first 3 months, as far as other portfolios that I have that are similar, have underperformed slightly. I think the CCF portfolio actually has done a little bit better this quarter. So there is a little bit more of an index pull there, but there is some differences in a relative sense from a performance standpoint. I would say everything that we're doing now from an asset allocation standpoint is ultimately going to reduce the volatility that we may see for the balance of this year. But at the same time, it's important to maintain the broad exposures that we have. Bonds have taken the fullest brunt of the downturn in the portfolio, at least from what you might expect. A lot of folks. Oh, Troy, you're back.
Sorry.
Welcome back.
Did your computer reboot too, like mine did?
Sorry about that.
I was just kind of talking high level about asset allocation and performance. I wasn't even sure how far you had gotten because I got booted off, and I had just come back.
Okay. So, in the interest of time, I will kind of move a little more quickly and, get through the slide. I just was pointing out, part of what you were talking about in terms of asset allocation. We haven't made the move yet and we are in the process of reducing high yield as Ryder.
Technology.
Yeah, it looks like it.
Troy, you're jumping in and out. If you can hear me, maybe you can unshare your screen.
So this is Ryder. I'm sharing screen now. I took over since Troy
You
fell
took
off. So
over.
I can go ahead and move forward as needed to let me know.
Oh, okay. Well, why don't we click ahead if we're able to?
Sure.
Hey, Kyle, this is Deacon. Did you see Kevin's question?
Oh, I did not. Kevin, can you address the magnitude of the portfolio rebalance? So I think he's referring to the endowment piece there.
So the magnitude to some extent we've already moved kind of that 3%. Part of that was an actual rebalancing and some of it was market move. I would say that directionally the move will likely be another 1 to 2%. Everything that we do kind of in my history with these portfolios, with the sub asset classes, the tactical moves, oftentimes are in these 1 to 2% increments. Even if down the road we decide to get even more cautious and move to a slight underweight, again, it's likely to look like a couple of percent move between, say, stocks and bonds. Like I was mentioning before, bonds have taken it on the chin. We don't expect that downturn in bonds is just going to continue ad infinitum, and to some extent the higher yields are more attractive to buy bonds. Fortunately, with this, especially the Catholic savings pool with such a very short portfolio, the concept of time as your friend is also true, in that you'll continue to earn your coupons, and as maturities happen, we're able to reinvest at much more attractive rates. So from an asset allocation standpoint, rebalancing standpoint, the plain answer is the magnitude is going to look like a couple of percent here and there.
Okay, because Ryder, and that helps. I was just trying to get a quick appreciation of equities move from 60 to 55 million. Was that a $3 million movement and then a $2 million market reduction? And I think you partially, I got most of the answer.
That it is, it's probably adds up to about a 50-50 split.
Yeah, I can get you the exact numbers there that we did at the end of the month, if you'd like. I don't have those.
No, that's fine. It's just the order of magnitude is fine.
Okay.
All right, Troy, you're back online. Are you having computer problems, Troy?
Not that I'm aware of. I don't know if there was just an internet disturbance, but it seems to be okay now. So now that we're on to the fixed income piece of the portfolio, and we also added to fixed income a bit during the rebalance. And again, essentially buying in at higher rates and, trying to get better positioning in the portfolio at the same time. So we do have an effective duration that's lower than the index. So that's helpful as well in a rising rate environment where 87% of the index and still have an overweight to corporates versus treasuries overall. And, do have some in the, you can see in the triple B category, overweight there as well to, again, try to get some higher yield there. One thing that I'll also point out, we do have some tips that are off index, so that also has been helpful with the inflation. And you can move forward. This is the intermediate pool, very similar story. Again, we did do that reduction, and Ryder is probably correct with the order of magnitude, but the same type of moving closer to that 50-50. And, it does, with markets moving every day, it's hard to, hit everything right on target as we're doing that rebalancing as well. But we tried to do it in a thoughtful way, in a way that, does move the portfolio in the direction we want and get to, as close as we can to those targets. Similar story, though, across the board in terms of, performance and allocation. And we kind of went through the Catholic screening as we normally point out, very, very high levels of compliance in all of these portfolios, and we're paying attention to that and, constantly trying to refine that over time so that the impact is as de minimis as possible given the solution set that we have. This is the new capital preservation pool. And as I mentioned, it's in its fledgling stages. We have entered into some structured notes, some portion of equities. There are some limitations that we had to get into large cap. The large cap portfolio has a limitation of 300,000, just because there are so many names in the portfolio that the names get very, very small. So you're not able to trade the way that you would want to if the portfolio gets too small. So that's why the limitation there. But we are moving towards the targets. We may add some additional structured notes again to buffer this portfolio. Again, it's a process. We didn't want to jump in with both feet here, and we're trying to ease it in a way that will help the portfolio, protect on the downside, but also be able to take advantage of some of the growth.
Quick question. Do we expect to have that entire equity portion go away and into the structured notes? How do we have that structured from a strategic?
The way that we modeled it, Kyle, the way that we modeled it was a 50-50 split of equities between long only and buffered.
Okay. Okay.
Yeah, and right now, although we did some further investing in April, we can shift some of that towards structured notes to, you know, better achieve that as we move forward, that 50-50. Again, we kept the compliance, you know, maintaining that. And it was just a quirk. You might think this is the same number as the intermediate portfolio, and I had to do a double take and I ran the numbers again, and it's just a quirk of the asset allocation. For even though they're allocated differently, it's two different assets somewhat, and it came out to the same number. So the Catholic Savings Pool, again, there is some implementation of structured notes, and again, this is the short corporate Catholic Values fixed income portfolio that's 100% compliant across the board. And if you move to the next slide, we can see the net returns. And again, you know, we spoke about this earlier. I think that we're still trying to manage in a way that is focused on the next phase, right? So we're positioning the portfolio to get through this time period, and, you know, weathering it pretty well in terms of, you know, where it's benchmarked. I know that, you know, it's always hard in these portfolios where we're trying to meet a set positive amount, but I think the best case here is just to remain patient, and I think, you know, just given where rates are going and the shortness of the portfolio, it will turn itself around. Just another snapshot. So we are shorter than the index, even a short index, so 2.5 years in terms of duration. And we are dipping down a little bit lower in terms of credit quality than the index. So you can see that BBB here, percentage of portfolio around 67% versus the index at 38%. So again, positioning for the next phase, weathering the storm and then getting to hopefully a good place.
Whoops, I'm sorry, Troy, if you could go back one. On the fixed income side, to the extent there's going to be new additions to the portfolio, what kind of a coupon, or I'm sorry, current yield are you thinking we're looking at, and how is that shifting? Obviously up, but to what extent?
Right. So, you know, even this chart as of 3/31 depicts the yield to worst for the portfolio anyway is around 3%. If we think about where rates are in that 2 to 3 year range, you're going to still, as you're buying into either new issues or issues on the market, it's going to get in that 2.5% new coupons, where, you know, just a year ago we were struggling to get much yield at all out of new issues or you know, existing issues from a yield to worst standpoint. It's probably more a question, though, that I would have to take back to our bond desk to see where their sweet spot is and what they're targeting in terms of yield. So I can go back and get that if you'd like.
Yeah, that I'm on another board where we're going to be it's a municipal board, and we're kind of looking at, in a month, the yield's going to be in the 325, 350 range for 20 to, it's a combination of 20-year series and 25-year series. So That's why I just in look, and it's a AAA credit quality. So I've got that in the back of my mind, seeing then the current yield of the portfolio that we have. If I could spit that word out, I'm sorry. But then looking at the credit quality, I'm weighing two sides. One is what we're going to be offering not priced correctly, or on this other board, or do we have more opportunities here within the CCF for turnover of bonds? And I realize these are 5% coupons. They're going to be paying at a premium, so that's why I'm trying to stay on the current yield to understand that.
Right, right. And I think you mentioned munis. So the function in munis right now is a little bit different than on the corporate side. So you can go up in credit quality and still obtain that yield. I think right now they've been hit a bit harder. And so from that standpoint, I can see where they're at. And if I understand your question, you're trying to see if there are any opportunities, or if at the higher credit quality range, are we finding places to add additional current yield? Is that
Right,
fair?
right. It's more in what would the target of a new purchase be in the fixed range, and I realize buying today versus buying in 6 months, I would expect the yield to go up in 6 months.
Right.
And I guess one question I'd piggyback on that is to the target that we're looking at from like a duration perspective. Are we still aiming low? Like, will we be aiming lower than our current effective duration, or are we looking to go out further just out of curiosity? Because I guess that's a thing that kind of depends on also the demand for cash. I would expect within the next year, we'll probably see demand for cash in the, $2 million to $3 million range. So that's something I'm still, this summer is one of my projects to kind of map out the needs for cash over the next 12 to 18 months. So that's what I'm estimating at this point in time.
Yeah. And we can keep get another look at the maturity schedule related to that, and kind of try to, we do have some cash in there reserved for structured solutions right now. So we do have a little bit of a buffer, but it's also something that we're looking to invest a little more opportunistically. But it's basically managing that maturity schedule. But I can get a little bit better sense, I think, having a conversation, and maybe I can even have one of our bond managers that manage this portfolio. That might be a good agenda item for next time.
I would say, Kyle, that it's likely that this 2 to 2.5 year duration portfolio is still the right target duration for what you need and how you use it. It doesn't make a lot of sense to extend because the yield curve is so flat and will likely remain there. The idea that interest rates are going up, the Fed funds rate is going up, but the 2-year notes have shot straight to where they are because of the expectations. The yield improvement though that you're getting, going from I think sub 1% to over 3%, is what you've been waiting for, and you're gonna get there. You're not there yet though, because you still have a seasoned portfolio, but you will get there.
Excellent, thanks. So I guess at this point, is there anything else you guys wanted to cover in the slide deck?
I think we can leave it there unless there are questions about any individual strategies or other questions around what we've already talked about. But I think it's a good place to end. And always happy to take questions offline. If you want to get more detail, please feel free to give me a call, shoot me an email, or funnel that through you, Kyle. That's that's fine. Always happy to do that.
Absolutely. Absolutely. So I guess before we do close out, anyone else have anything else they want to add or any questions? We will be seeing them again on Tuesday next week, so stay tuned for that. Okay. Sounds like we're all set, guys. Thanks a ton for your time today, and glad we made it through those technical difficulties. So great stuff.
Yes, sorry about that.
Hey, that's
Thank
all right.
you.
It happens.
Thank you.
Thanks,
Thank you,
guys.
guys.
Take care.
Great.
Thanks, everybody.
Take care, all.
Have a
Bye-bye.
great day.
Bye.